Today, Mary Carter and Stephen Ross are joined by Dan, a lawyer and business consultant with Purpose Equity. They dive into the critical legal and financial planning every business owner needs for a successful succession or sale. Whether you plan to pass your business to the next generation, sell to your employees, or find an outside buyer, this conversation will help you prepare for a smooth and profitable transition. Let's get started.
Welcome back to another episode of HVAC Full Blast. My name is Mary Carter.
And I'm Stephen Ross.
And we have a new guest on with us today.
We do, and I'm excited to introduce Dan. I've known Dan for a long time, just personally, but then also had the chance to work professionally with Dan starting a couple years ago. And he's got a wealth of knowledge that is both general, like we could ask him just about anything, he probably knows the answer, but also very specific in the heating and air world and just the trades in general. And so I'm excited. I got all kinds of questions lined up for you, Dan, and we're ready to go.
Sounds
nice
good.
to meet
Glad to
you.
be here. You too, Mary.
But Dan, just to give everybody else a background, so how did you? So you're a lawyer, you're a business consultant, so you own a law practice. That's kind of one separate thing. You've also got a kind of business consulting brokerage business that's separate. How did you get into, like, when law school? Is this like, hey, this is what I want to do, is kind of business law, or how did you end up going down this path?
No, actually, I just knew a bunch of lawyers who made a bunch of money, and I thought I want to do that. And so that was my, 24-year-old brain decision to go to law school. But I went to a large law firm here, located here in Columbia, South Carolina, and was there for about 6.5 years. And through the last half of my career there, my time there, I focused on working with larger privately owned businesses and really got a taste for the business world through that, and realized that I really wanted to be in the business world as opposed into the legal world. And so I left that and went to a small investment banking firm here in Columbia as well. We help people sell businesses, we help people invest in businesses, we help people value businesses. And that's really where I began my consulting career. That business blew up because the owner died in a rock climbing accident, actually. And that's where a lot of the lessons I learned came from, was going through a really bad business transition through that transition, because he had no paperwork and nothing planned, and basically decided to make it my life's work to make sure that nobody else had to go through that again. So what I do now on the legal side is work through business transitions as an M&A attorney. We also do profits, interest awards, and all kind of other business paperwork kind of prior to a business transition. But the main amount of time that I spend now is actually on a business that I have also called Purpose Equity, where it's an investment bank and consultancy, and we help people grow their businesses, value their businesses, and then eventually transition their businesses.
Wow, what an interesting proposition that you were in the business of transitioning businesses, and then you had to go through one kind of suddenly on a dime. That's really, that's an intense testimony to why that you need this process.
Yeah, I wouldn't recommend it, having personally gone through it, and it was very trying, but looking back on it, I would not change it, because it's a lot of the lessons that I learned that I apply to current clients came from that very troubling and difficult experience.
So if we'll ask you lots of questions, and you maybe should tell us which hat you're wearing when you answer the question. Is this like your legal hat? Is this the business consultant hat? But, when we first kind of worked together professionally, I owned a heating air company. I had a business partner. What was unusual about our partnership is that we were true 50-50 partners. And a lot of people told us going into it, like, that's not going to work. Somebody's got to be the tiebreaker. There's got to be a way, and so I think in our operating agreement, we designated our CPA as the tiebreaker, but in 7 or 8 years, we never once actually had to resort to that. So maybe we got lucky, but having a 50-50 partnership did actually work for us. But it then created a little bit of a paperwork chain, because we had to make sure that we had set up everything correctly in terms of decision making. We had to have a buy-sell agreement. We had to buy life insurance on each other. So Dan, maybe just, our listeners tend to be people that own heating and air companies, and and that could be of all size. It could be like 10 employee shop, in a small rural area. It could be a 150 employee shop in a big major city. But do you have a checklist? Like when you sit down to work with a company where you're like, all right, step one is we got to make sure you got all your paperwork straight. Like, what is that checklist?
Yeah, great question. So here's how I think about it, and especially because you have listeners potentially all over the country. Different legal documents can be called different things in different areas in different states, right? Just different states have different laws and therefore different things, different pieces of paperwork are called different things. But the substance remains the same. Okay, so here, like basic blocking and tackling type of legal paperwork needs to cover four main areas. Okay, death, this we call it the 4Ds: death, disability, divorce, and decisions. Okay, those are the four main things you have to have covered. It could be in an operating agreement, it could be in a shareholders agreement, it could be in bylaws, it could be in a separate buy-sell agreement. I don't care what the legal paperwork is called, right? Leave that to the legal technician in your state. But you have to cover those four things, and you have to cover them in writing on a piece of paper that all of the business partners have signed so that they all are in agreement. And then hopefully you have it in writing, and then you never have to look at it again because you never have a death, you never have a divorce, you never have a disability, and you never have a decision-making dispute. So the 4Ds are all bad things that could potentially happen that you hopefully never have to dust off your operating agreement or whatever the legal document is for. So like you were saying, Stephen, you have to have a buy-sell agreement. That typically involves, a death. Somebody dies, one partner has to buy the other partner out. What does that look like? Is there key man policy? Because if you have one guy that was the operations guy and one guy that was the sales guy, when you lose one of them, you lose that skill set. So is there a key man policy that covers the person that's now gone? Usually disability applies the same way, right? But there's some nuance there because disability involves, is this guy actually disabled? Is it going to be for 6 months or a year? Or is it a permanent disability? Those sorts of things. Divorce is an even more difficult situation. It's very rare that a judge or a jury would grant, the departing spouse ownership in a company, but it does happen. And so you need to build that situation into your legal documentation. But really the most common thing that happens is a disagreement, right? And so that's why you have to build decision making into your agreement. As you said, Stephen, you had a tiebreaker built in. You and your business partner were 50-50, but you got good advice from somebody. I don't remember if it was me or not, but somebody told you that you needed to say, somebody has to have a tie break here. And so we made our TPA the tie break. So as long as your legal paperwork covers those four things, those 4Ds, you're covered. And the technical legal name for all of those documents does not really matter as long as it's on paper and you are using the right paperwork for the type of legal entity that you own.
Okay.
And I'm going to go on a limb here and say definitely want these things if you're in a partnership, but probably also want them even if you're a sole owner, right? Or probably want them even more.
Yeah, that's a great point, Mary. So if you're in a partnership, whether it's 50-50 or 80-20, or you have 5 different owners, you definitely want all those things. But if you're a sole owner and you pass away, typically your business goes away, right? And so the way to make sure that you have the ability to retain that value in the event of an untimely passing or disability is to have the right documentation in place. So you have a key employee step up to run the business while you're gone. You have a business broker involved to maybe sell the business quickly from the estate. You have the right insurance in place to maybe hire a new CEO. So there are a lot of different ways to do it. But point is that the paperwork defines those ways. And you and your wife and your key employees or whoever it is that owns the company sit down together and discern, if something happens to me, here's what we want to happen. Do I want to sell the company? Call the business broker. Do I want to continue the company? Do a buy-sell agreement with the key employee. Do I want a key man policy so then I can go out and hire a new CEO? Whatever you decide is the right path, you build the paperwork and the insurance around that path.
That makes sense.
And even, to Mary's point, if you're a sole proprietor, I've got 5 kids. So if I own a business outright and I die, it's great that in theory. Well, you just go, I in my will, everything just gets left to my kids. Well, who's going to run the business? And what if the 5 kids don't agree? And like, are you just setting up this next generation for an absolute disaster because that none of that was thought through? So I think that was an interesting. I mean, we paid money, but we got really good advice. And so, I mean, I had a trust set up. And so in your trust, what happens basically, everything's going to get liquidated. The kids are getting money because I don't want to obligate them to be in business with each other. I mean, that, maybe that works out, maybe not, but if they get the cash, they can decide to go buy a business together if they want to. But I mean, it's just those types of things that you don't really think through until you have a trained professional that says, hey, probably never going to happen. But if it does, let's think through what's going to, kind of catch this scenario. And, you don't want to get caught off guard.
Yeah, Stephen, that's a great point. I would say that, like in any family situation, communication is the most important. And it goes without saying that is the case with family businesses as well. And so when you're thinking about a transition, whether it's a purposeful transition to a son or a daughter, or a non-purposeful transition, meaning somebody passed away and there's an emergency circumstance, you really need to communicate ahead of time what you want and how it needs to play out. So you did the right thing by saying, you know what, my kids, they're all too young to take over the business, but you didn't know if you were going to die when they were old enough, right? But the point is that you said, you know what, I don't want my family fighting about my business. Let's just liquidate everything. Everybody gets cash and they can go be on their way. And then if they want to do something with it together after that, that's fine. But the last thing we want them to do is be fighting about, who's going to run the business and who's going to be the CEO and who's going to be the COO, and somebody wants out, but the business can't afford to take them out. There's just too many pitfalls to doing it that way without communication. So you took the very smart and probably the easiest route by suggesting that at the time.
I think we're going to have to change the name of this podcast from HVAC Full Blast to Clear Expectations, because it really just comes down to that in so many different facets of life.
That's exactly right. Communication is key.
Mary, I'll give you an example. I've got some friends who are married and they don't have any kids, but they both have siblings. And so they formed an LLC. And so we're sitting down talking about that. And I was like, so what happens if one of you dies? What happens if both of you dies? Like they're like, oh, well, just everything's going to go to our siblings. And, but the trust attorney that when I met with him, he was very good at coming up with these scenarios that help you see, like you actually have to spell it out. And the one that made them stop and think was, you get in a horrific car wreck. One partner dies immediately. All right, so what happens? Well, the other partner survives for a month. Well, the dead partner's assets now all become property of the surviving spouse, right? But then a month later, that surviving spouse dies. So in that scenario, everything what was joint property now becomes property of one person. And when that person passes, it goes to all of their siblings. But the siblings of the other person got zero in that scenario. So you'd have to think through, okay, how are we going to, what if this happens? And I mean, it is staggering. And I don't know, Dan, do you have any real life scenarios where you're like, I know you said you lived through one, but what are some of those real life lessons learned where you're like, hey, we never thought this would happen, but it did, and we had the paperwork, or this happened and we didn't have the paperwork, and here's the fallout?
Yeah, so I did live through a real life scenario where there was a situation that not everybody agreed with what to do with the insurance money. So in our particular scenario, the gentleman who passed away, where I went through a bad business transition, he could not get regular life insurance because he had a kidney issue, but he was able to get key man insurance for some reason. So the insurance company was able to underwrite key man life insurance policy, but not regular life insurance. And so, as you might know, key man policies are intended to fund the business in the absence of the key man, so that the business can continue to run and then build itself back up after 6 months or a year or 18 months after the key man has passed away. Well, because he did not have any regular life insurance, his widow said, well, that's actually all my money, and it was intended to be life insurance for me to use. And we said no, and the insurance company was not necessarily on board with that because it was key man policy, and it was meant for the use in the business. And so she named herself president of the business and then began to use the key man policy to fund her life. And so it was a situation where there was no paperwork other than the insurance policy itself. There was nothing written down. There was no trust. There was no buy-sell agreement. There was no anything. And so nobody had any clear direction from the gentleman that had passed away, and nobody really knew what to do. And so that resulted in a really, really bad business transition where we fought about the ownership of the business for 18 months. And eventually there was a lawsuit as a result of that, and it got settled very quickly. But it went through 18 months of backwards and forwards and ups and downs and a lot of wasted money on attorneys that didn't need to happen if the deceased had it written everything down and made his plan clear prior to passing away. And so I know exactly where you're coming from. And those situations, as much as you might like to make them up over the dinner table and think about them theoretically, they do happen. And most often they result in litigation and people spending a bunch of money on lawyers and fighting it out and wasting time instead of actually saying to themselves, what do I want if this happens? Let's make that decision. Let's communicate it and let's write it down and move on. And if it does happen, everybody has clear direction on what to do and who gets what.
So, Stephen, we talk about how sort of like the time value and or sort of as an appointment goes on, time and anxiety pitches, right? And if I'm someone driving along, listening to this podcast right now, and I'm thinking about these scenarios, and I know I don't have these things in place, my anxiety just hit a new high.
Yeah.
So what are some of the practical ways, Dan, that we can get started on putting some of these vehicles in place? Because this doesn't, it does seem to me like something that feels very theoretical. How do we make it actionable?
Yeah, great question. So you got to make 2 phone calls. You got to find an attorney if you don't already have one, right? That person can theoretically should be able to guide you through the paperwork piece. Like I said earlier, it doesn't necessarily matter what you call the paperwork. You can do all of this in an operating agreement if you have an LLC. You can do all of this in your shareholders agreement if you have a corporation, or you can do it in separate agreements. Operating agreement, buy-sell agreement, all kind of different ways to do it, right? So don't worry so much about saying, here's the paperwork that I need. You say, I need a piece of paper, or probably multiple pieces of paper that cover the 4 Ds. And let's cover those 4 Ds somewhere in some piece of paper. And your attorney, in whatever state you're in, should be able to walk you through all those different pieces and parts, and then build the rest of the agreements around it, right? Because agreements have all kind of different things other than the 4 Ds. A lot of states require a lot of boilerplate, but we don't need to talk about that right now. But you go to the attorney and you find the right person to make sure that they can cover the 4 Ds somewhere in that paperwork for you. The second call you make is to your insurance broker, and you say, listen, I'm doing some planning around my business. I'm working on a buy-sell agreement that's going to go into my operating agreement or my separate buy-sell agreement, and I'm going to bring in this key employee, and he's going to buy the company from me if I pass away, or however you want to set it up, whether it's your son, your daughter, your key employee, your business partner, whatever. You go to your insurance company or your insurance broker and say, I need a certain amount of money to fund this buy-sell policy. So if my company's worth $4 million and I own 50% of the company, I need $2 million worth of buy-sell insurance to fund the purchase of the company by my partner if I passed away. Right? So those are the 2 calls that you make. The third potential call that you may need to make, depending on how wise your insurance broker is and how wise your attorney is to a business valuation person, right? So sometimes that's your accountant. Sometimes that's somebody referred to as a CVA or a certified valuation analyst. But typically accountants sometimes have those designations. And so in this situation, you don't need to call a bunch of people that you already don't know, right? Typically, everybody has a business attorney of some sort. Everybody has an accountant. Everybody has an insurance broker. It's just having the right conversations with those people that you already know. So you call the attorney and you ask them about the paperwork to build out the 4Ds. You call the insurance broker to ask them about a key man policy or a life insurance policy, depending on what you're funding. And then typically you would call your accountant and at least start with the accountant to get a business valuation done to determine how much insurance you need to buy. Sometimes insurance brokers, and this is sort of a little known fact, sometimes insurance brokers actually have those resources in-house and will do the valuation work for free because they know they get to sell you an insurance policy. Some insurance brokers don't do that, but some of them do.
And they like to make up real big numbers, so you got to buy a real big insurance policy. So that actually works out great.
That could be one reason not to do it that way.
Business, but hey, like, you know, nice. Yeah, it is overwhelming, I think, and so for me, you know, when Tim and I became business partners, like we literally kind of came up with our own valuation on a napkin. And I mean, here's how we did it. Tim had personally started the company and had about $300,000 in personal debt. And, you know, really just was like, holy crap. I mean, it was like the vehicle loans, the building, the warehouse, like the forklift, like he had to buy everything. And so what we did is we said, hey, let's call the valuation $600,000. And if I buy half, I'm going to give you 300 grand. And now you're out of personal debt. It didn't quite work that way because what we found is, all right, that's great. But now any future vehicle we needed to go buy or any future, we still had to personally co-sign on behalf of the business. So that was kind of our next business challenge was like, hey, how do we show a valuation or cash flow to the degree that a bank looks at that and goes, okay, Stephen, you no longer need to personally co-sign on this loan. The business is worth enough now that the business you can sign on behalf of the business to borrow the money to. So Dan, that maybe is more of your consulting hat. So when you come in, not necessarily on the legal side, but you come in on the consulting side to a small business and maybe their finances are a little bit jumbled up, where do you start there to help kind of untangle the mess?
Yeah, that's a great question. So what you're talking about is transitioning from what we talked about at first, which is sort of building the legal foundation of the business, right?
Yeah.
Think about like you're building a house. You can only build a house that fits on the foundation. If it's too big, it'll topple over. If it's too small, you spent way too much on the foundation. And so we build the legal foundation first, have the documents ready, have the buy-sells ready, we have the insurance policy ready, and we understand that we have a good, solid foundation of who owns the business, what happens if somebody dies, what happens if somebody gets disabled, what happens if somebody gets divorced, and then the decision-making authority of all those individuals, right? So that's the foundation we're building. Now we're talking about like, how do we grow the business basically, right? That's sort of what we're getting into. And so, you know, to what you're talking about, Stephen, there's absolutely nothing wrong with doing a business deal on the back of a napkin like you and Tim did. I got no problem with that, right?
We're great,
yeah. Two consenting adults who decided this was going to be our deal, okay? Yeah. Those kind of things happen all the time, and I actually don't have a huge problem with that. Now, you theoretically want to put that pen to paper at some point and put paperwork around that deal, which you did. But coming up with the valuation on the back of a napkin, frankly, is fine for a small fledgling business like it was when you bought Tim out, or at least bought 50% of the business. Now, with that said, getting from there to where you ended up is a different story, right? And so one of the keys that a lot of business owners sort of overlook during the growth phase of their business is making sure they have really good financial help at the beginning of the process, so that they are heading in the direction of a thoughtful and appropriate business transition at some point. Mm-hmm. And so that whether it's to a child or to a buyer or to a partner or to whomever, having the financial base, just like we talked about having the legal base, now we're talking about building the financial base of the business. And building the financial base really looks like two things. One is you need to have a really good accountant who can help you understand cash flow, the difference between accrual and cash accounting, how to plan for capital expenditures and purchases next year, how to save on taxes, those sorts of things. But you also need to have a good banker who you stay in touch with, who understands your business, who understands how you're trying to grow your business. And the more you bring them under the tent and show them how your business is running, the better terms you're going to get from the bank to be able to grow the business. And the more likely at some point you're going to be able to get off of those personal guarantees. Mm-hmm. Now, here's the struggle that we see all the time with business owners, okay? And this is a tension that doesn't necessarily have an answer, but has a trend. It's the tension between your accountant and every business owner ever who wants you to pay, and you want to pay as little taxes as possible, right? And so you're spending money, you're trying to do a Section 179 deduction, you're trying to drive down your net income as low as possible to make it look like you didn't make any money, so you don't pay any taxes. But guess who doesn't want to see that? Your banker. Your banker wants to see you making money, right? Because they're going to give you better terms and better options if you are making money. So that's the tension that every business owner struggles with. And the reason I say it sort of transitions over time is because the way I think about it is when you're starting out, it's okay to be thoughtful about trying to save on taxes because you do want to make sure that you pay Uncle Sam as little as possible. But with that said, you don't want to hinder the growth of your business. And so you don't want to search for every last deduction. You don't want to buy a truck every single year and spend, $95,000 on a new Ford F-150 Platinum because you got that money in the bank, right? Let's make smart business decisions, not fun personal decisions that might save you on taxes. So if you're going to try to buy 3 new trucks next year for the business because your fleet's getting old, but this year you're like, oh, I got $100,000 extra, I'm going to go ahead and buy myself a new pickup. That's going to be fun for you, but it's going to look bad on your balance sheet next year because you just went and spent fun money on yourself and didn't save up for that money next year to buy and increase your fleet. And now it's going to cost you more because the bank isn't going to give you as good of a term. Mm-hmm. So thinking about that tension is always part of every business owner's difficulty, right? The difficulty between taxes and showing net income, what accountants want to do and what bankers want to do. But as you think about eventually transitioning the business, whether it's, like I said, to a partner, to a son or a daughter, or to a third-party buyer, you need to start hedging more towards showing net income than saving on taxes, because that's going to increase your business valuation. And that's everybody's ultimate goal at some point, right? Is everybody has to retire. You can't own a business past the time that you die. And so you theoretically want to transition that business to somebody for a good dollar amount. And the way to do that is have your books very tight, drive as much net income to the bottom line as possible. Don't worry about paying Uncle Sam. If you have to pay Uncle Sam, it means you made a bunch of money. And drive net income to the bottom line so that your valuation increases, and that gives you way more flexibility on how to transition your business.
I think, I'll give my business partner, Tim, some credit. Like, one of the things he decided very early on, when he was a sole proprietor, if he wanted to, remodel his garage, he could go buy a whole bunch of stuff at Home Depot and run it through the business and basically pay pre-tax dollars for all that stuff, right? Mm-hmm. But once we were partners, he was kind of like, hey, the point of this is going to be to drive value of the business. So therefore, we really did a pretty good job, back 5 or 6 years in not running personal expenses through the business just to save on taxes. We're like, hey, does paying taxes suck? Yes, but what are you going to get for that money down the road if it shows up as profit? Both the ability to borrow against the business then goes up, and to Dan's point, your future value is going to be your retirement plan. So that's good as well. Dan, what's one of the things that we hear? You talk about net income, but we also hear the other term EBITDA. So EBITDA tends to be what gets kicked around a lot of times when you're specifically talking about valuations. Can you give us kind of a quick rundown? What is EBITDA? What's the difference between that and net income?
Yeah, I thought you were about to start beatboxing, Stephen.
Yeah.
So I'll give you an example of how people don't even know what EBITDA is, and then I'll explain what it is and why it's important. Okay. So this is 5 years ago now. I helped a guy in this industry sell his business. And when I first took a look at his financials, he had about $900,000 of net income. And I thought, okay, this is a pretty good size, HVAC related company. And then we went through and we started adding back all his personal expenses. Well, he paid for his horse farm,
Oh,
his beach house, his 2 boats, including one very sizable boat in Charleston. Everything other than his actual house where he lived was paid for out of the business. So he
wow.
went from $900,000 of net income to $2.7 million of EBITDA because he was running over $1.1 million of personal expenses through the business. Now, if we not bothered to go do that, he would have sold the business for way less money if we had not added back all those personal expenses. All right, so let's talk about what EBITDA is and how we got from that $900,000 to that 2.7. Okay, so EBITDA is earnings before interest, taxes, depreciation, and amortization. And basically, what EBITDA tries to do, what it tries to measure, is the cash flow capability of your business, absent any financing activities.
Okay.
Right? So if you had no debt, you were doing no financing of any type, how much cash flow would your business produce? That's really the key. Okay. And so earnings before interest, taxes, depreciation, amortization. So anything on your profit and loss statement that falls under those categories, interest, taxes, depreciation, and amortization, gets added back to your net income to create EBITDA. Okay. So you take your net income at the bottom of your P&L, you add back those 4 things, and that gets you to your EBITDA number. And the reason that is used as a basic valuation metric is because when you sell your business, whether it's to a partner, to a son or a daughter, or to a third party, that's the measure that banks look at to value companies. That's the measure that valuation analysts like we have here look at to value companies. And that's the measure that third party buyers use to value companies. Because you wipe away all your financing activities and say, if we didn't do any financing, how much cash flow would this thing produce? And that's the number. Okay. So you add those 4 things back to net income. And let's say, and I think in that instance, that company had about $700,000, $800,000 worth of add backs. So we went from $900,000 of net income to about 1.6, 1.7 of EBITDA. Okay. Well, that's a much bigger number. And so therefore you have a much more valuable company.
Mm.
Now, on top of that, what we do is we go back and we do adjusted EBITDA. Okay. So net income is the lowest number typically. You add back the 4 things, the ITDA, interest, taxes, depreciation, and amortization, to get to EBITDA, slightly bigger number, right? Now we add back all the personal expenses, and those get you to adjusted EBITDA. And the difference between that guy's EBITDA and his adjusted EBITDA was about $1.1 million, because all of those personal expenses were being run out of the business. Typically, it's not that much, but you think about, your son's and your daughter's car, cell phones, family vacations, gas. Sometimes there's a boat in there. Sometimes there's a Corvette in there that's not necessary to the business. You add all those things back and you go from 1.6 or 1.7 of EBITDA to now 2.6 or 2.7 of adjusted EBITDA. Everybody's company is different. Everybody treats their company differently. But running those personal expenses through the business is the purview of any business owner. And everybody does it. I do it in my business, and I don't necessarily have a problem with it. But as you get closer to transitioning your business, you want to back those things down and do it less, because you're always going to miss something, right? You're going to miss a phone bill. You're going to miss a gas payment. You're going to miss something. And if you stop doing those personal expenses 2 to 3 years prior to you wanting to do a transition, your company's going to be worth more. You don't have to fish through your general ledger to make sure you caught all your personal expenses. And your company's going to be worth more as a result of that.
Yeah. And it's not like you're saying, like, don't run any personal expenses ever. You're just saying, think about it as you're thoughtfully transitioning, and maybe through that transition, you take it as a result of net income, but it's not as part of this adjusted EBITDA.
Yes, that's right.
Yeah,
That's exactly right. So yeah,
that's
everybody
so
does it. I
interesting.
got no problem with it.
That feels like a level 5 financing tip, but it's a really simple way to make sure that you're increasing that value of your business. I'm just thinking about my own kind of personal finances and that just how important that would be, right? To think of that in terms of valuation. Yeah.
That's
So
right.
Dan, just to make sure I understand correctly, so let's say I want to go buy my water bottle here, and it's $10. So
Yep.
in one way to do that would be to say, well, Stephen, you've got to earn $13 so that you can pay $3 in taxes, and then you can buy your $10 water bottle, right? The other way to do that is to say, well, hey, wait a minute, I'm going to buy the water bottle through the business, and now because it didn't have to go through and pay income tax on it, I saved $3. But what Dan's saying is, yeah, but you've got a $10 business expense now, that the value of the business is going to be 8 times that or 10 times that or 12 times that or something like that, right? So if I don't buy the water bottle through the business, while it costs me $3 in taxes, if the multiple is 10x, well, I just added $100 to the value of the business. So I paid $3 in taxes, but I added $100 to the value of the business. That's an overwhelming decision then to go, of course, you should just pay the taxes and buy the water bottle yourself. Dan, am I summarizing that correctly?
Yeah, that's right. So, the issue is, if assuming you don't capture that as a personal expense and you pay $10 for that water bottle,
Yeah.
and you get 10x for your company on your valuation, you're getting $100 less for the value of your business than you would have if you hadn't bought the water bottle.
Right.
Well, would you pay $100 for that water bottle? Absolutely not.
Right.
Now, if you captured it and it was an add back to get to that adjusted EBITDA number, it's okay, right? But who keeps track of the $10 water bottle? Nobody, right?
Mary,
now,
I
you won't
think
miss the $120,000 Corvette.
well, we should test this theory. I think Mary should buy a Corvette, put it on your company credit card, and then if you could just let them know, hey, they can add that back into their adjusted EBITDA and it will just turn out fine, then, I think we're good. I think you should test that out, Mary.
All right, that sounds good. My next phone call is going to be to my lawyer, and just to make sure that I'm covered, and then I'm going to call my accountant, and yeah, and for kicks, I might just call my insurance person because I might drop dead of a stroke if I did that. So.
Probably a criminal defense attorney as well.
Yeah. Oh wow, that's so interesting. I'm truly fascinated by this, and I have a finance background, but it is. It's something that I've really only come across when I got married. We made sure to do some estate planning and to, kind of start thinking about some of these scenarios on paper. And I have to say, like, it was, I think, Stephen, you said earlier, staggering. It was a little daunting. I remember feeling a little bit like we just decided to get married and now we're talking about what happens when you die. Like, I'm not ready for that. And what kind of advice would you give to somebody who's listening and maybe just is still kind of feeling like, whoa, this feels a little daunting?
Yeah, good question. I would really have two things to say about that. One is, all we're really talking about here are pieces of paper, right? There's nothing to be scared about. So nothing is permanent. Everything can change. But it's just paper. So don't be afraid of it, right? Don't be afraid of calling your lawyer. If you got to spend $500 to sit down with that person for an hour, it's definitely going to be worth it. But in the end, it's just paperwork. And theoretically, you won't have to look at it for several years after you do it, right? So it's once every 5 years. You should probably dust it off once every year to at least look at it and make sure that it's still says what you want it to say, but maybe you actually change it once every 5 or even 10 years, depending on your life circumstance. Maybe you get married, maybe you have kids, whatever. The other things I would say, and this is probably the most important part, is that your documents are intended to point you in a particular direction, right? So think about it that way is, you as the business owner, you got your head down every day. You are working in the business. You are making sure that you're getting new jobs, that you keep your guys busy, that your trucks are running, that your marketing is working for you, all the different operational pieces of the business that frankly are the really hard parts, right? But your legal documentation is really, where do you want to end up? What are your goals for the business? And so that's, like I said, that's the foundation that you're building. And so if you say, I'm 47 years old and I have a 13-year-old son who is really handy and can probably take over this business from me at some point, that's a great thing. We would love that to happen. But do your documents recognize that, right? Mm-hmm. And so if you want that to happen, your documents need to point you in that direction. Or if you want your business partner to buy you out, let's say you're 50-50 and your business partner is 42 and you are 62 and you want to retire in 3 years and no longer own the business, then your legal documentation needs to point you in that direction of you being bought out by your much younger partner at some point, right? Mm-hmm. And so, when you found a business, usually people found a business because their boss made them mad and they figured they could do it better on their own. And we see that all the time, and that's mm-hmm. great. But eventually, if they get it up and running and they're doing a really good job, it really becomes something. And it becomes something that's meaningful to the family, to the key employees, to the general employees. And so when it becomes something meaningful to those groups of people, you have to make sure that you point it in the right direction to accomplish the goals that you want it to accomplish. And that's really the key behind doing the paperwork, right? Don't be afraid of the paperwork, because it's just literally pieces of paper. But your paperwork points you in the direction that you want to go. And so you figure out what that direction is, and then let the paperwork point you there. And then when you ever decide you want to change that direction, it's time to change the paperwork.
I love that.
What about, so let's, if I ask you to kind of put your lawyer hat back on, or maybe this is one where you wear both hats. Like, one of the challenges is, again, our industry, if we look at the average age of a heating and air technician, if we look at the average age of a heating and air business owner, like we getting up there in age as a group. And so a lot of folks are looking at, hey, how do you hand this company off to the next generation? So kind of that succession planning. I want to give the business to my kids or to whoever. We also get a group of people who say, well, wait a minute, we're going to create an employee stock option program where the employees will then buy the business. And so we'll kind of keep it running that way. Or maybe you got a third group that's like, well, we're just going to sell the business and we don't care who we sell it to. We'll go get a broker and we'll just put it up for sale. But maybe we could just start with succession planning. Do you have any tips for the folks who say, hey, we actually do want to hand this off to the next generation? What are your thoughts and just kind of getting going there?
Yeah, great question. So I really think about three main things that you need to do to handle a thoughtful internal transition. Okay. And so that means typically father to son, mother to daughter, mother to son, whatever it is, right? There's a family transition, uncle to nephew, whatever it is. And so those types of transitions are the most likely to get screwed up because what we talked about earlier, because the people didn't talk, right? The dad didn't talk to the son, or the mom didn't talk to the daughter, or whatever it is. And so the first thing that you have to do, so if you're the dad or you're the mom and you own the business, is my son or daughter even capable of running this thing, right? If they are, then you can move on to the next step, which we'll talk about in a second. If they are not, you have to have a hard conversation, right? Because if the child thinks they are capable, but you don't think they are, you really need to have that hard conversation. Communication is very difficult. As you know, in families, communicating about anything is difficult. This would be a particularly difficult conversation. But what you're doing is, if you don't think your son or daughter is set up for success to run the business after you're gone, you're setting them up for failure, right? So how do you make sure that they can be set up for success? If you don't think they can handle it at all and they're never going to be capable, you have to have that conversation. If you think they can be capable, but they're not yet capable, and you got to get them some training or whatever it is, then you need to go through a thoughtful process of building them up. Maybe they're really good technicians, but they don't understand finance and accounting. Maybe you send them to some online finance and accounting classes, or have them sit down with your accountant or whatever it is. Maybe they're really good at the finance and accounting part, but they don't understand operations. Send them out into the field for a year and get them that training. Whatever it is, purposely building them up to be ready for that transition is something that doesn't happen often enough. Usually it's, all right, son, I'm ready to retire. I'm 63, you're 33. Here are the keys. Good luck, right? And then the 33-year-old goes, I don't know what to do. Nobody told me how to do this. Nobody trained me how to do this thing. And so being thoughtful about that preparation, making sure that son or daughter is ready to take over the business is the key, okay? The second piece of it is, do they even want to, right? If they're capable, do they want to? And just because you think you want them to take over your business doesn't mean they necessarily want to. So you have to have a hard conversation with them about making sure they're ready. But if you think they are in fact ready, they have to have a hard conversation with you. Do they even want to do it, right? So we've seen situations where the expectation was the son was going to take over the business. The son took over the business. The dad had a heart attack. He didn't die, but he was no longer there to help. The son came to us and said, I never wanted to do this. I don't want to do this anymore. How do I get out of this? Yeah. So you have to make sure that it works both ways, that the son or daughter is capable, but that the son and daughter also wants to do it.
That's so interesting because we talk about that concept of want to, capable of in sales all the time. And it's interesting in this order, you're sort of saying capable of, want to, but how true is that, Stephen? Like we talk about that with just your belief system and your mindset, you know, if you want to make this money, are you capable of doing like what is needed? And I love hearing it in the reverse there.
Yeah, I do it in the reverse because it's really the elder person's responsibility to have the first and hardest conversation. Yeah. And then the younger person's responsibility to have the second and potentially less difficult conversation, right? So those are two potentially hard conversations that need to happen. But if you get past those, right, if the son or daughter is capable and wants to do it, then we have to figure out how to put together the financial package to make it happen, right? And that, frankly, that's just math. That's sort of the easy part. So if you hire somebody like us or a really good accountant or another business broker or somebody who has the ability to run some pro formas, understanding financing packages, understanding valuation, that'll take care of itself, right? Because you have a mom or a dad who's on board and a son or a daughter who's on board, and they really know how to run the business well. That's the hard part, right? Finding financing to do an internal transition of a business within a family, oh gosh, banks love that. They'll follow themselves to finance that. So as long as you've done some of the things that we talked about earlier, which is not spending too much on personal expenses, making sure you catch all your add backs, understanding all the differences between personal expenses and those add backs, making sure you understand cash versus accrual, all those pieces and parts. If you do that, financing part is the easy part.
Gotcha. What about, let's say the next generation is not interested. They're like, I got no desire for this, but I also just don't want some outside company coming in and ruining the culture that I've built and maybe the brand name that maybe is my last name. And so what I want to do is I've got some employees in the business. Maybe I'm selling it to all the employees. Maybe I'm selling it to the management team. I've heard the term ESOP, employee stock option program, or something like that. There's also phantom stock. I mean, what's kind of the quick rundown of maybe those two things?
Yeah, we can talk about sort of really three options. One is transitioning your business to employees, okay? Just not outside of an ESOP, which I'll explain in a second, but doing an internal transition to one or two or even three or four key employees is just as simple as it is to do it with your son or your daughter. Are they capable and do they want to, right? Those are two very important things. If you get past that, the financing is the same, right? In fancy finance world, that would be referred to as a management buyout, right? An MBO. All that is a fancy acronym for the management's buying the company, My key employees are buying the company, okay? So it works the same way. Are they capable of it? Do they want to do it? You go to the bank and you find the financing. You get the valuation done to determine what the purchase price is going to be. And banks will typically finance those relatively easily, assuming they know that that management team is going to be there, that they're qualified to do it, and they're going to keep running the business like the old owner has run it, right? So you can do just a management buyout, a key employee buyout, just like you can do with a son or a daughter. Okay. One step, and you mentioned this very briefly, Stephen, to get to that point, that will help you get to that point. A lot of folks like to do either phantom equity or what are also called profits interest awards. Okay. So phantom equity is just like it sounds. It's phantom equity. And basically all that means is you are saying to your general manager, if you have a key general manager, you're a key employee, you're valuable to this business. I want you to stick around for the long term. I'm going to give you 5% phantom equity or 5% profits interest in this business. So in addition to your salary and in addition to whatever bonus that you've earned, I'm going to grant you 5% phantom equity. All that means is they have now a piece of paper that says, if this company throws off $100 this year, you get $5. Mm-hmm. Right? That's all that means. And if we sell it for $1 million, you get $50,000. And so it's just a piece of paper that commemorates that relationship that says, hey, you're not just an employee anymore. We're making this a little bit more serious. I'm now giving you some of the profits, which before that, only me as the owner was entitled to. But now I'm granting you some because you're so important to the company, right? That's sort of a first step into a management buyout, right? Maybe your son goes off to be a dentist and your daughter goes off to be a doctor, and you don't have anybody to take over the business, but you have a 27-year-old who might be the general manager one day, and you say, listen, by the time you're 35, I want you to own this business. I want you to start out with a profits interest award. I'm going to grant you 5% of this business, and then for the next 5 years, every year for the next 5 years, I'm going to grant you an additional 1%. Okay, great. Now I have 10%, and after that 5-year period, they can start then buying you out of actual equity with a bank loan through the circumstances that we discussed before. And so internal transitions to family members, internal transitions to key employees, profits interest awards. The profits interest awards are the first step to those first two internal transitions that we discussed. Let's talk real quick about ESOPs, okay? So ESOPs are a special animal of employee transition, okay? It stands for Employee Stock Ownership Program. And that is allowed by the federal government. It is a particular type of ownership allowed by the federal government. And I only know enough about them to be dangerous, so bear with me on that. But those are typically reserved for much larger companies, at least 2 million of EBITDA, but probably 4 or 5 million of EBITDA, because of the administrative burden associated with putting them together. Because there's a lot of government reporting, you have to have a valuation literally every single year. People get bought out and bought in all the time. And so if you have 150 employees and you're doing 6 million of EBITDA, you can afford all those administrative burdens. And you might be big enough where you want to do that. ESOPs can be very lucrative for the business owner, because if you sell to an ESOP, the numbers are usually pretty good, right? They might not be what a third-party buyer would be, but they're typically better terms than what a son or a daughter alone could pay. So they are very burdensome. They are very costly. They take a long time to set up, but they can be good for the right business owner if the business owner has a group of key employees and really wants to take care of that group along with the rest of the employees who are there. So that's the ESOP piece. It's a specific type of employee ownership.
Okay, gotcha.
Yeah.
A last question along those lines. Let's say, all right, I'm not going to do a management buyout. I'm not going to sell it to my children. I'm not going to do the ESOP. I am eventually just going to sell it to somebody. I'm going to put it on the open market. So kind of like getting a realtor, you go get a broker, and you are a broker. So kind of full disclosure is I use Dan as my broker. But let's say you own a business and you're shopping for a broker, Dan. Kind of like a realtor, man. I mean, there's good ones and there's bad ones, and there's ones that have a ton of experience, and some people just don't even know what they're doing. And like, so what are 2 or 3 things if you were shopping for a broker that you would look for?
Yeah, great question. Really kind of 2 main things, okay? One is trust level, right? You are going to show this person, if you decide to use them, everything about your business, everything about your family, all your financials. They're going to understand everything, all this personal information that you really don't show to anybody except for maybe like your lawyer and your accountant, okay? But because your lawyer and your accountant is typically a long-term relationship, you build that trust over time. Your relationship with your broker is typically shorter, right? Because they're usually only involved for maybe a year or so, give or take. And so you have to make sure on the front end that you have enough conversations with them that you trust them to put your interests first, right? And here's what I mean by that. The brokerage business is contingent fee driven. So if you decide to sell your business, you're going to hire a broker, they're going to get paid on the transaction, and typically only on the transaction. And so brokers want you to sell your business. But what you need to do is find a broker that says, I don't care if you sell your business or not. My reputation is too important for you to just sell your business. We're going to find the right partner for the right amount of money to make sure it's the right cultural fit. And if it's not, we're going to kill the deal because it's not worth it, right? So you have to trust that person to act in your best interest at all times, even up to and including killing the deal at the end if they think it's going to be bad for you or if they think it's going to go poorly, okay? So trust level, number 1. Second level is how hard are they going to work? And that's really important, right? So like I always use the example, and if any residential real estate brokers are listening, I'll apologize. But what you don't want is a residential real estate broker type of broker to say, yeah, I'll take your listing, I'll throw you up on the internet, and I'll wait for people to call me, right? That doesn't do anybody any good. You want a broker who's going to bust their behind to make sure that they find every single buyer, overturn every leaf, look under every rock, because that's going to do 2 things. If you make sure that you figure out the entire world of buyers out there, you're going to do the 2 main things that we care about. One is get the highest and best price and get the best cultural fit. And that's really the combination that we're looking for. And if you have a lazy broker, they're going to hedge toward the highest price and don't care about the cultural fit. Or if you have a lazy broker, worst case scenario, you're not going to get either of those things. You're not going to get highest price or good cultural fit. And so a good broker is going to look for those 2 things and make sure they uncover every stone to make sure they find every buyer, so that when the time comes, we get the right fit and the right purchase price.
That makes a lot of sense. I'm thinking about, we've talked about mediocre salespeople, and boy, if you've got a mediocre broker who's feast or famine, that sounds like a recipe for disaster.
I do not recommend it. It's too important.
Yeah, when we did the process, Mary, and I first sat down with Dan, this is kind of what opened my eyes a little bit. He said, hey, there's probably 1,500 groups out there that would be interested in the type of company you have. And out of those 1,500, like, our initial job is to whittle it down to 50. And like, who do we want to sell to, right? And then out of those 50, we got to whittle it down in a hurry to get to your top 3 to 5. And those are going to be the guys that you really kind of do a lot of the legwork with for them to check out your company. But that's the work, in my opinion. It's not just, to Dan's point, you're not just putting a sign in the yard and going for sale, right? It's like you want to select your buyer. And so that really was eye-opening in terms of how much work selecting the buyer was, when you go, man, there's 1,500 groups out there, and I feel like I talked to all of them at some point. So it's like, whoo! But yeah, it was work.
Wow. Well, I feel like there's 3 things in life that are certain: death, taxes, and when you listen to HVAC Full Blast, you're going to learn something.
You're going to learn something. Hey, Dan, I've been waiting for Dan to come on our show so I can hit Dan up for some free legal advice. So you ready in like 60 seconds or less?
Lay it on me.
It's probably more than 60 seconds. I can't do anything in 60 seconds or less. All right, so
This can't be attorney-client privilege, by the way, because there's hundreds of listeners.
oh yeah, no, this is here's what I think you're either gonna say. You're either gonna say, dude, you need to come and see me before you go to jail, or you're just gonna say, I think you're fine, right? So like either way. All right, so I've got some friends, and we go on vacation every year together, and we've last couple of years we've gone to like St. Thomas to go, take a week at an Airbnb down there. We went to Breckenridge. We've gone to Costa Rica, right? We just like going on vacation together. So here's what we did this year is everybody threw some money in a pot. And so it's kind of interesting. So I made everybody form their own LLCs, and they all had to go get trusts to put their LLCs in. But then all of those LLCs are now owners of the big LLC, and we put all the money in the pot. And we went and bought a little house, and we're renting the house out. And because we paid for it in cash, we didn't have to mess with getting a loan, all that kind of stuff. But now that we've got a tenant in there and it's cash flowing, we're getting ready to go borrow the equity out of the house. And one of the guys owns some land that's right on a major road. We're going to get ready to go build a billboard. And again, we're going to pull the money out. We're going to go pay cash for the billboard. So we're going to own the billboard outright, and then have an advertising agency handle all the sales and whatnot. So once that starts cash flowing, we'll be able to pull money out of that and then bring it back over to the house that we bought, which has a lot that's actually big enough for 2 houses, and then build a second house on that lot, which we can then rent out. So here's what we think is that within about 5 years, we'll be cash flowing probably $50,000, $60,000, $70,000 out of this little LLC. And because we're a multi-member LLC, we are required by law to have an annual board meeting. Am I right so far?
Feeling like a full circle moment now.
Next year's board meeting is Iceland. And this company will never make a profit, but our board meetings will be spectacular.
So you're asking me, is it okay for you to go to Iceland and put it on and pay for it as a business expense?
It's a board meeting, man. We got to get together and talk about all this. And I mean, it's probably going to take days.
If I could use my new knowledge, it sounds like as long as you're okay with an adjusted EBITDA that is, not favorable to your valuation, then maybe it's okay.
Very good, Mary. That's where I was going to go. You nailed it.
And we've got, buy-sell agreements. Now, we're not funding our buy-sell agreement with life insurance. I think what we're going to do is say if somebody dies, we're just going to liquidate the business and then divvy it up based on shares that way, because nobody wants to be in business with anybody else's kids or anything like that. So, we've got to look. That's what I need to come talk to you about. I got to get our operating agreement amended with a buy-sell agreement. So, but
gotcha. That's easy. We can do that all day.
So do you think it's legal to blow 100% of the profits in the business on the board meeting?
Legal?
It's got to be.
Yes. Recommended?
No. But it's a self-perpetuating vacation fund is really what it is. Like, we don't want to buy timeshares. We want to just have a self-perpetuating vacation fund.
I mean, if you were looking at real estate opportunities in Iceland, it's a reasonable business expense.
Yeah. Well, see?
Maybe you want to buy an Airbnb in Iceland.
We should go check it out anyway.
You won't know until you get there.
That's what I think.
I pretty much have never traveled anywhere without doing some real estate investment research when I'm there, because I pretty much love everywhere I go. But wow, that's so interesting. Well, Dan, this has been incredibly eye-opening, educational, and maybe a little thought-provoking too.
Glad to do it.
And Dan, just so, I'm getting ready to give your email out. Is that okay?
Totally.
So I use dan@purposeequity.com. Is that the best one to reach you on?
That's correct. Yes.
And so just so listeners know, Dan doesn't do it for free, but if you need a consultant, it's worth it. So
excellent.
Thank you.
And if you didn't catch that, you can always also email us at HVAC_full_blast@traintechnologies.com. We can connect you with Dan. And other than that, color me impressed. This was a really, when Steven said he wanted to bring his lawyer friend on the show, I was like, I don't know. It sounds expensive.
I don't blame you.
I like how Dan said that your relationship with your broker is supposed to be really brief, because I keep calling him. So he's like, yeah, no, your insurance agent, you keep calling that guy. Your broker, it's supposed to end at some point. And I'm like, hey, I got more questions. Anyway.
I love it. Well, Dan, thank you so much for your time. And Stephen, thanks so much for tapping into your network. This was really fun.
Woo. See you guys next time.
Thanks, Mary. Thanks, Stephen.
Bye.